Okay, so one of the most misunderstood areas of personal finance is about how much you can pay into a pension. And guess what? It's surprisingly common to make mistakes. In fact, I'm going to be telling you why pretty much nobody is going to have £60,000 to pay into the pension this year, despite the fact that's the new annual allowance. Got you there, haven't I? Okay, my name's George and I'm a chartered financial planner. I help people achieve financial freedom and retire on their own terms. And I should of course say that some of these rules are going to be quite complicated and I can only really signpost the main areas and give you some resources in the description to have a look. So this is a YouTube video and it can only ever be a guide. So if in doubt, get advice specific to you. Okay, so to explain this properly, I need to separate this into two types of pension contributions because the rules differ for each. So we've got individual contributions, and that's contributions by, you guessed it, you. And secondly, employer contributions. And these are contributions coming from your employer. Or perhaps maybe if you're a limited company, then technically the contributions are from that limited company, as it doesn't go by you as an individual for tax purposes. Okay, so as we remember, those two are going to be separated for now, which I'm going to come back to. So right now, let's focus on individual contributions. So to reinforce, this is for an individual who wants to pay into a pension. And to try and explain this visually, I'm going to bring in some useless graphics because, have you ever seen my channel? So let's imagine that we've got kind of different hurdles which have to be passed. And once we get past them, we can get on to the next. So the first mistake is thinking I can put £60,000 myself into a pension and get tax relief. And while for tax year 23-24, that is correct on the annual allowance, if you're making a contribution, your tax relief is limited to what's called relevant earnings. Okay, so what on earth are relevant earnings? So to have relevant earnings, you've got to be under the age 75, and to put into a pension and to get tax relief, you can either put in what's called 100% of your relevant earnings, which I'll come back to, or £3,600 after tax relief. It is important to say that actually you can throw in whatever you like into a pension. It's just you might not get tax relief on what you throw in. So we're going to kind of assume that you want tax relief. Otherwise, it's a bit of weird pension planning technique there. And what on earth are relevant earnings? Well, look, basically this is employed earnings, bonus, overtime, all the rest. You might be self-employed. If that's the case, then it's self-employed individual profits from the trading year ending in the tax year, or maybe you partner their share of the profits. It's benefits in kind. It's also the taxable part of redundancy payments because the first 30 grand is typically tax-free, and also some taxable payments in lieu of notice. But what's more important to say is that what relevant earnings doesn't include are dividends, savings income, rental income, which is a big one, and pensions in payment. Also state benefits as well. Very simply, the simple way to think about it is the majority of your taxable earned income. If all of those sources that you earned were 100 grand, then you theoretically could put up 100 grand into a pension and get tax relief. But hold on, you might be thinking, don't be stupid, George. Look, you can only put in £60,000 per year from this tax year into a pension. That's what I heard anyway. Well, look, spoiler alert, you can still carry forward the last 3 years' unused annual allowance. So let's go back to that £100,000 example. That individual would exceed their annual allowance if they threw £100,000 straight in. As long as they have relevant earnings though and carry forward, they could potentially put £100,000 into the pension. But to explain how the tax relief would work, we have to dive into how individual tax relief is applied. And there are three main ways of getting tax relief on individual contributions, and one other way which a lot of people use called salary sacrifice. I'm going to go over them all. Okay, so the number one is relief at source, which is typically the tax relief method for personal pensions, group personal pensions, SIPs, stakeholders, and some other schemes. And what happens is the individual contributions are made net of basic rate income tax. And that pay has already been taxed. And then the scheme administrator applies to HMRC for basic rate tax relief at 20%, adds that onto the individual's pension fund. Now for higher or additional rate taxpayers, you can claim back any tax relief via self-assessment. And then the relief is received via either adjusting a pay of an individual's PAYE code or maybe via self-assessment. You can actually also write to the tax office quicker to potentially get a refund. All right, the second method is net pay, and this is mainly for occupational schemes. The employer deducts the employee's gross contribution from the gross pay before PAYE income tax is calculated and passes on the contribution to the scheme administrator. So it's effectively deducted before tax is applied. And that's how it gets tax relief. Basically, it's before tax is applied. So you don't need to make a separate claim here for higher or additional rate relief because it's just been put into a pension. And then the third one, which is hardly ever comes up, is for retirement annuity contracts. That's called relief on making a claim. I'll say this one quick because it hardly applies to anyone. Anyway, for payments to retirement annuity contracts, they're made gross. The individual claims the tax relief via the self-assessment tax return. And the final one is salary sacrifice, which is similar but not the same to net pay, where you have to be employed clearly, and as you sacrifice part of your salary via an agreement with your employer, the money goes straight from your employer to the pension, and this can reduce national insurance for both the employer and the employee, and also give you immediate tax relief because effectively you've not been taxed on it. What about carry forward? So let's talk about carry forward. And this is, I think, pretty straightforward. If your annual allowance in a particular tax year isn't used fully, it's not necessarily lost. You can carry forward unused allowance for up to the last 3 tax years when looking at whether your contributions will exceed your current annual allowance. And if you have exceeded your current annual allowance and there is unused allowances from the 3 previous tax years, you can bring this forward to cover any excess. Look, you've got to be a member of a registered UK pension scheme to be eligible for carry forward, but you don't have to have contributed to that scheme. Okay, so now the annual allowance. So we're simply down to the annual allowance, which for tax year 23-24 is 60 grand. That's one of the ones that went up in the budget. It used to be 40. Now that is the total for you and your employer, the annual allowance. Simple enough, right? Well, it is for a money purchase scheme because basically it's what you put in, your employer puts in, cold hard cash, you got it on your statement, you just read what you put in. Quite simple. But what happens for the wonderful world of defined benefit? And you might be an active member in a DB scheme. And look, well, the position here is much more complicated for that. In fact, your individual contributions to a defined benefit scheme are often not same in any way to what your annual allowance is if you're active in a scheme. Confused? Yeah, that's understandable. Okay, so here we go. For a defined benefit scheme, the input amount is the capitalized value, oh my god, you wonder why I've got a job, of the increase in DB benefits over the input period using a factor of 16:1. So basically, what kind of HMRC says, look, when you have pension increases, it's a guaranteed income for life. So we can't just say, look, a grand of pension increase is a grand for annual allowance, because you'll get that grand every single year when you draw the pension for the rest of your life. Loads of caveats here, just stick with me. So let's kind of run through how this works. So the input amount is calculated by subtracting the opening value of the benefits from the closing value. And how this calculation is done, bear with me, is, okay, so we've got the opening value first. That's effectively the benefits at the start of the tax year, capitalised using a factor of 16:1. If the scheme provides a separate lump sum, you've got to add that on. And that gives you a total value. So let's say the pension at the start is worth 10 grand. Now, you're also allowed inflation increases because a lot of these pensions have inflation increases, so they keep their value. And it allows the increase to be increased by inflation, or specifically consumer price index from September of the previous year. So we're going to say that inflation's been 5%. So actually now we're at 10,500 because of that 5% inflation. Now that figure is 168,000. Ooh, big number. So the closing amount is the increased pension amount at the end of that pension period, times by 16. So we're going to carry on this example, and we're going to say that your pension went from 10 grand to £11,000. The £11,000 times by 16 to get 176,000, subtract it from the opening value, and there you go. You've got 176 minus 168, so £8,000 towards your annual allowance because you were active in a defined benefit scheme. And can you see why I have a job? Okay, so I've also got to cover off tapering. So I'm just going to very briefly mention that, look, for very high earners, there is what's called the tapered annual allowance, which actually also reduces down your annual allowance. This only really applies to high earners, and this could get fiendishly complicated. So I'm just going to kind of brush over it. There are 2 tests whether your annual allowance will be tapered. But from April 2023, the adjusted income threshold is increasing to 260. Now, if you are at that point, you probably should get advice because this is going to get way above what most people can really be bothered doing. I think the easiest thing I can say is, look, if you're one of the lucky few that earn that much, it's definitely worthwhile getting advice. An advisor can typically add a lot of value when you get to that kind of level, and it's definitely worth making sure you're doing those tax calculations so you don't get a letter from HMRC. But you could also maybe get caught out by the money purchase annual allowance, and this reduces the amount you can pay into a money purchase scheme. So it's not affected defined benefit scheme, that's a separate calculation. It's only relevant for money purchase schemes. And what happens is, it's when you take flexible benefits, and what used to happen is your annual allowance for money purchase schemes went from 40,000 to 4. But again, this changed in the budget. So now you've got £10,000 from the 6th of April 2023. And that means that's the most you can put into a money purchase scheme if you trigger the money purchase annual allowance. So that was a lot to go over, but we've understood the importance of relevant earnings, how the annual allowance and carry forward works, some things about DB scheme which I think about 1 or 2 people might have understood, and what we need to be aware of when we're thinking about this. But I need to now explain about employer contributions. But before I do, come on, consider subscribing to the channel. It makes a huge difference to getting more content out to good people like you, and I would love to have you on the journey. Okay, so there are technically no hard and fast limits to employer pension contributions. However, any contributions have to satisfy what's called the wholly and exclusively requirement to receive relief for corporation tax. Now, genuinely, there is no real way to describe the wholly and exclusive rule apart from my understanding, which is that it's HMRC's way of saying, look, don't take the mick. And what they mean is that, like any business expense, to be allowable as a deduction against profits, pension contributions have to be made wholly and exclusively for the purpose of the business. This means that contributions should be at a reasonable level, however you define that, for the individual concerned. And HMRC guidance typically makes clear that pension contributions will normally pass the wholly and exclusively test and qualify for tax relief. But if there is no clear trade purpose, then tax relief might be restricted or not allowed. So I know that sounds super vague, but typically how I would do this with my clients is if it was a position where there were large contributions that were being made, perhaps for a director who's about to retire, it's normally just a case of having a discussion with their accountant and ensuring they're comfortable with signing off any contributions and with the planning. It's important to say that employer contributions do count towards the annual allowance. So when you're doing carry forward calculations, if you are, you need to be aware of that. But if any of that stuff does apply and you have more than £60,000 that you can put into a pension, well done to you, you're doing all right. But to recap, we've gone over relevant earnings, how tax relief is applied for individuals, things to watch out for, common misunderstandings, and employer contributions. So let's go back to the thumbnail and why you might not be 60,000 you can put into a pension. Because look, it could be, but it's just very unlikely. As for that to be the specific figure, you'd have to have no carry forward, relevant earnings, employer contributions added to it, and then hopefully now you know how to work this out. But look, all this planning is pointless if you save a ton on tax, but then make huge retirement mistakes. And you can catch up on what they are and how to avoid them in this video.